right. We're ready to start. Are you guys ready to rock? Hopefully you have questions for me. This is Andrew Stotz, and I'm really looking forward to tonight to get started. I got a lot of stuff I'm going to go through. I'm going to go through the performance of the all-weather strategy and where we're at right now. And then after that, I'm going to be talking about some special topics related to strategy, things that we have to think about, such as elections and things like that. And so those are some of the things that I'll be talking about. But before we get started, I just want to say that you should feel free to start asking questions. My goal is to answer as many questions as you can send me. Now, sometimes my questions, I may not be able to answer everything, but please send your questions and start sending them now, and I'll do my best to answer them. You can send them in English. That would be easier for me. If you send them in Thai, it's going to be a little bit of work for me, and I may not be able to figure it out. But I want to welcome everybody here, and it's great that you take the time to spend time with me to go through the performance, and we'll go through that very soon. And I want to say hi to everybody out there. I see there's Anne and other friends of mine, and it's nice to see you all. Tonight, I'm free at home, and that's because my mom went out. She did physical therapy, and then she went out for a dinner out. So mom's out relaxing, having some wine and some ice cream. So that means the house is empty, and I can spend a lot of time with you guys. So I'm going to get started, and I'm going to share my screen, and I'm going to go through strategy. But please, for all of you guys, Chunlada, I see. Nice to see you. Prem, nice to see you. Warasit, Paul's already asking excellent questions about defensive asset class. What would be best? And we'll talk about that. I'll get into that question. I like that one. Let's talk about that one for just a second. Let's go ahead. This is a good question. For defensive asset class, whoops, I just pushed my desk down. Hold on one second. There you go. For the defensive asset class, what would be best between infrastructure versus REITs versus bonds? Ultimately, for defensive, you probably would prefer bonds. Now, I know that many people say, well, bonds aren't earning anything right now. That's the reality is that bonds are something that can protect on the downside. So bonds have two functions. Obviously, you can try to earn some return on the bonds, but you don't get that much out of bonds. But the other thing about bonds is it's capital protection. So if I had to choose between infrastructure, REITs, and bonds, I would say bonds is number one. Second, probably infrastructure. And third is REITs, because REITs have a very high correlation to the equity markets. All right. I see others here. I just took that question because I thought it was a good one right off the bat. So feel free. Welcome, Mayuri. C Smile. Chanya says, who am I? Hua? I don't know. And Bunyamon, nice to see you. Nice to see everybody here. Let's get started. We got 314 people on the call, and I'm going to share my screen. So let me do that right now. Whoop, there we go. Whoop, there. So we're going to go through this. Let me get started. And remember to ask questions. I love questions as much as I can. So remember that the strategy is global, long-term, and diversified. Global means we invest globally, not only in Thailand. Yes, there's a little bit of our portfolio that's in Thailand. And so I invest mainly globally. Again, welcome everybody. I see Dr. Surasi. Welcome. It's good to see you. And long-term means gains from long-term equity return while reducing the portion of losses during the downtime. We're trying to prevent massive losses. You're never going to be able to get away from losses. A portfolio, any portfolio could go down by 20, 30, 40, 50% even. But we're trying to reduce that. And then diversified, meaning diversified globally across 4 asset classes. And that's a big difference between Alpha Focus and AWS. AWS is simple, 4 asset classes, and a little bit within the equity asset class. But we try to keep it simple. All right. So today I'm going to talk about developed equity, and I'm going to review the performance basically. And I'm going to look at the performance relative to 60-40 portfolio, which we did outperform. I'm going to talk about a special topic, which is about U.S. politics. This is something I've been working on for a while, but I expect Democrats to lose control of the House of Representatives, and that's going to weaken the Biden presidency, and it has a lot of implications. That brings me to the second special topic, which is Democrats need Federal Chair Powell to prop up the markets, not inflation. Actually, the Fed may talk about inflation, but that's not really going to be the real focus, and I'll tell you more about why that is. And then the outlook: central banks let the West run hot, commodities driven by demand recovery and supply chain disruption. And then I'll look at some regional FVMR snapshots for equity markets, and then I'll talk a little bit about the risks that we've got in our portfolio, like US default is one, new lockdowns, and also inflation turns out to be transitory. So take a look at this chart. I always love to start with this chart. It just breaks the markets down into the 4 asset classes. The asset class, let me just grab my pen here so I can share this. First, we have stocks, equities, then we have bonds, then we have gold, and then we have commodities. Now, for some people, you know that commodities actually includes a little bit of gold. I believe it's about 5 to 6% of total commodity funds have gold in it. But I look at gold also as a separate asset class. So we actually have gold represented in 2 areas. And I'll take a little quick break and say to Amit, I see your question. That's a good one. What's your opinion on digital assets, especially real estate tokenization? I'll talk a little bit about that later. Jutamas says, hi, Andrew. And Bess says, good evening, Mr. Andrew. Nice to see you guys. So now let's look at the performance. And one of the things you can see is this goes back to the question that was asked earlier. The question that was asked earlier was, what would I choose? This was Paul Warasit. Would I choose infrastructure, or would I choose REITs, or would I choose bonds when I'm thinking about defensive? That was the question that came up, and there's the question. And this particular chart really shows it all. What you can see in this chart, and I'm going to go into the chart myself here and see if I can. Sometimes I get lost in the different screens. Okay, so here we are, and what we can see here is that the bonds is the blue line right here. So the bonds don't move that much. They've been in a rally. They've moved up a bit, but it's not a lot. And that's the defensive nature of bonds, that blue line. When the equity market's super high, we may want to reduce and put money into bonds. Now, the second thing we can see is gold has been pretty flat over this period of time recently, and commodities had a run, but now you can see that commodities have kind of flattened out right now. And we'll talk more about that coming up. So this is our asset class weight since December of 2021. We've made no changes, so we just keep going with what's working right now. That's 65% asset allocation to equity, 5% to bonds, so we're not really that defensive, 25% to equity to commodities, so we're playing the inflation story in AWS. In Alpha Focus, we've reduced some of that commodities, but remember, these are 2 very different strategies. You don't want to look at them and compare too much. They're just very different. With Alpha Focus, we're doing a lot more aggressive bets. Here, we're trying to be careful in what we're doing. So, and then 5% in gold. So now, US has been the long-term clear winner. We can see in this chart that the US here is the red. And in fact, developed Europe was a big laggard, but then had a pretty strong run. That's the blue line. Emerging markets, moderate. Asia ex-Japan has started to outperform, but it still hasn't been able to beat what's happened in the US. So let's look at our equity weighting. So we have, remember, I'm going to go back. Remember, we have 65% in equity. So how did I allocate that 65? 25% is to US, 25% to developed Europe, and then 5% to Japan, emerging markets, Asia Pacific, ex-Japan. Now, sometimes people ask, why do you have a weighting of 5%? Or even in Alpha Focus, we have a weighting of 2 or 3 or 4. The point is that we try never to get completely out of an asset class, because you just never know, number one, when a particular asset class could fly. And we at least want to have a little bit of that. Or you never know when a market could crash, and we at least want to be somewhat diversified. And that's the reason why we tend to always maintain at least some exposure. So heavy in Western developed markets, right? In our June 2021 revision, we switched our 25% allocation to the US and developed Europe from emerging markets in Asia, ex-Japan. Now, we made no change in the September and December revisions, and we haven't made any changes as of right now. We got a Santa Claus rally, and that despite the fears of Micron in the news, we got a Santa Claus rally, and all assets showed a positive return in December 2021. Developed Europe was the strongest equity market, followed by the US. And strong US holiday shopping and approved big 2022 government budgets in Spain and Italy led to solid performance for the Western markets. What about emerging markets? Well, emerging markets underperform. Worries about new lockdowns motivated by Micron kept emerging markets in Asia, Pacific, ex-Japan behind the developed markets. Expectation of continued redistribution in China leading to a slowdown in the world's second largest economy dragged on further. And China constitutes a large part of emerging markets and Asia ex-Japan. So what China does is quite important for what Asia ex-Japan does, especially emerging markets. Now, we've had a low bond target allocation at 5%. And basically, we've been shifting that mainly into equity. The strategy is to hold only Thai government bonds rather than a mix of global and corporate, government and corporate bonds. We just keep it in Thai bonds. And other assets were up in the past month. So a small allocation of bonds was good for the strategy's performance. So here we can just take a look at the breakdown in commodities. I look at energy, industrial metals, so that's like copper and things like that. Then you have agriculture, and agriculture is wheat, corn, things like that. Then you have precious metals. This is going to be gold and silver. And then you have livestock, which is basically cows and cattle and pigs. And you can see that most of the movement in commodities has come from energy prices rebounding. So oil price recovered in December as supply was expected to tighten. And also markets were reacting positively to the news on Micron being a mild variant. The West Texas intermediary oil price closed December at about $75 per barrel. So gold was up a bit in December. We have a minimum 5% asset allocation. Gold reacted to inflation expectations and rate hikes by the Bank of England and expected earlier hikes by the Fed, which led to relatively high price volatility. While price was volatile, it rose in the second half of December as the US dollar weakened. And gold closed at $1,829 per ounce. Now let's look at performance. Here's the past month, our main allocations to the top 3 performers. This is our performance at 3.7 in the past month. And we can see that we were heavily weighted in developed Europe. It was the best performer. And we were also heavily weighted in the US. So we got it right this time. There's no guarantee we get it right next time. In fact, we could get it seriously wrong. But it did go right so far. And commodities were the 3rd best. So we really did very well. In fact, this is about as good as it can get. And we need to capture these gains while we can get them. So basically, we're now performing slightly above a traditional 60-40 portfolio. Since inception, the all-weather strategy has had a 45 to 65% equity allocation and about 25% to gold. There's no perfect index to compare to. 60-40 is kind of a traditional index that we look at in America. Really, 60-40 is kind of for people that are very, very conservative. So that's what we're benchmarking against. But I would argue that I don't really care about 60-40. What I care about is the next decade that we are able to protect the capital, number one, and that we're able to grow the assets so that you can focus on your job, which is make more money. As I say at home, I got to bring home the bacon. And that is when we are basically bringing home the money that we generate from our work. So now the strategy closed the year about 1% above the 60-40 portfolio. Now, again, let's look at our performance. And we're looking at it since inception, 2 years, 12 months, 6 months. And basically AWS has had a higher return and risk-adjusted return in all periods. So we're doing what we're trying to do is protect the downside. And also 60/40 had a lower drawdown only in the past year. Hence, AWS had a lower drawdown adjusted return over this period. So basically, we always want to have a higher than 60/40 number for the maximum drawdown. So in the past 12 months, our maximum drawdown was 6.2 versus 3.4 for 60/40. So 60/40 beat us. But also that's because it's just exposed to 60% equity, 40% bonds, whereas we reduced our bonds holdings quite a bit. So overall, I would say I'm happy with that performance. And mainly what I want to do is improve, let's say, the risk-adjusted return and improve the drawdown adjusted return. Now here, just to highlight that the portfolio since inception, the worst performance was down 20.5%. And that is from peak to trough. And that is a little bit less than 21.2 for 60/40. So we're doing okay. I would like to see it even better. But for right now, we're just trying to protect that downside and capture more of the upside. So AWS has experienced less volatility than 60/40. Basically, we've been mostly 25 to 65% target weight for equity. This has reduced volatility. And since gold is generally uncorrelated equity, it has reduced the overall AWS volatility. So we're slightly lower since inception on an annualized. Now, AWS has lost less on 8 out of the 10 worst days. This is a chart that really matters to me. What I understand is that, when my parents kicked me out of the house when I was 18 and I had no money, and I tried to make money and get a job and all of that stuff over time. And so every dollar that I made, I really felt like I really earned it. And I wanted to be careful not to lose it. My goal with this strategy is to try to help people protect their wealth. And this is how we're trying to do it, is try to protect that downside. So if we look at March 12th, 2020, kind of the heat of the moment, the market went down by 5.6% on that particular day. And we went down by about 4.4. So that's better performance on the downside. And we did the same thing here. We did the same thing there, the same thing. So it was only here in this case and here in this case that we did worse than the market. And that's what we're aiming for, is to try to reduce the downside volatility. So AWS outperformed 60/40 in 62% of the months. And this gives you a picture. You're never going to be 70, 80, 90% right. Here, we're just 62% successful. And if we do that, we're okay with that performance. So in 21 out of 34 months, the all-weather strategy has beaten a traditional 60/40 portfolio. Now, before we get into the special topic, I think now's a good time to stop and try to answer some questions. So let's see. Let's get back to the question that was asked by Amit. Amit, excellent question. What's your opinion on digital assets, especially real estate tokenization? I have to say that there's some things about digital assets that scare me. Things like where you keep them, how you protect them, how you prevent them from being stolen or lost or something like that. There's a lot of things about crypto and other things that I definitely have a lot of concern about. And I'm not alone. Even in Thailand, the SEC has a lot of regulations about crypto to try to prevent money for cryptocurrency from being lost or stolen. So first of all, with digital assets related to crypto, I always say that a portfolio between 0 and 3% of your total wealth in crypto is okay. Anything beyond that, you really have to be able to accept the fact that you could really have a huge amount of volatility. Now let's talk about real estate tokenization. We do have a case. There's a guy, and I forgot his name now. It slips me, but he's one of the first ones, Stefan, I think, who started a tokenization of real estate assets in Aspen, Colorado, I think it was. But he lived in Thailand for a long time, and he came back to Thailand also to sell that instrument. So I think you can tokenize real estate, and it can be a valuable asset. So I generally think that's a positive development. All right. Again, Jutama says hello. And also Beth says good evening. Poramet, Poor Matt, good to see you. Okay, about KEUX in AWS port. Some say that EU index is turning down. What's your view on this? Should AWS customers take profit for it now? Now, I like this question because it makes you think, right? It's very hard to try to outperform or perform well in the market. That's what I'm doing 24/7. I'm thinking about this portfolio, AWS and AF. Now, I'm making allocation decisions based upon what I'm reading in fundamentals, valuation, momentum, and risk through my FVMR model. When I say it's time to get out of Europe, it means that Europe is unattractive relative to the other asset classes that we're considering. When I say be in Europe, then I'm saying that it's attractive relative to other asset classes. Now, I look at that every 3 months. In between, poor Matt, I don't make any changes. In fact, I try to relax and read some books and work on other things instead of getting caught up in the day-to-day stress of the market, because I know the emotion of the market can cause us to do things, sometimes good, many times bad. So my point is, follow the work that I've done here and follow the recommendations exactly. If you or a client decide to say, oh, I'm going to change what Andrew's doing by, let's say, getting out of something faster or getting into something slower, then you're not going to get the return that I'm trying to get in AWS. Also, it means two strategies are going at the same time, and it's very hard to outperform. So I would say wait until I do the rebalance. All right. Everybody, feel free to ask questions. I'll do my best to try to answer it. Achara says, hi, nice to see you. And also, Tanita says, hi. And we've got a lot of highs here. Hello, Master from Wafflin. And let's see. This one, I like this name. Do not contact me. What's your point of view in emerging markets? Is it a good choice for long-term investment? So with AWS, I'm rebalancing every 3 months. So you could argue that it's not such a long-term strategy, although I'm going from quarter to quarter and then trying to think by decades. But the question that you're asking me is, do I think that emerging markets are a good long-term investment? The answer to that is yes and no. First, no. Reason why is when the US eventually crashes, emerging markets tend to crash much more. So the volatility of emerging markets relative to the US is very high, and the correlation is very high. So if you were to buy into the emerging markets and America was to crash by 30%, emerging markets could crash by 40 or 50%. So in the short term, if you believe that at some point the US is going to crash, then the emerging markets are not a great place to be in. Now, let's just say that the US stock market does crash next month. Then the emerging markets collapse. Then I think it's a good time for a long-term investment in the emerging markets, because the emerging markets will be much cheaper. They have a lot less debt, and I think that they're a good investment. So that's my feeling of it. Be careful in the short term because of volatility, but long term, I think it looks interesting. All right, next, Jutamat says, what is your opinion on debt level versus increased interest rate in the U.S. will impact the U.S. stock market return? Well, Jutamat, this question is the key to why I believe that there will be no Fed tapering. So what do I mean by that? What I mean is that the Fed is saying that they want to taper. The Fed is trying to start tapering. But tapering basically means taking money out of the market. Now, imagine this way. Imagine that the stock market is not doing very well in Thailand. And imagine that a person with infinite wealth who could buy the Thai stock market completely comes in and says, I'm going to buy and never stop buying. What would happen to the Thai stock market? It would fly, because everybody knows that a big buyer, like the Fed, as an example, has an unlimited budget and they're going to be buying. And that's part of the reason why the US stock market has gone up, because the Fed has been injecting money into the system, not in the stock market, but into the system. Now, what tightening means, and how do they do that? They do that by buying bonds. If a bank needs cash, they can sell the bonds to the Fed. So basically what you can see is that the Fed is providing a lot of liquidity for the banks and other institutions. Now, when the Fed starts tapering, it means that they're going to be buying less of the bonds in the market. When they buy less, they're pulling liquidity out of the market. And when they do, interest rates are going to start to rise. And although the Fed says we're going to wait to raise interest rates until we've paid down, until we've exited our position of holding a lot of government bonds, the fact is the market can move ahead of that. So interest rates are going to start to rise. When interest rates start to rise, what's going to happen to the stock market? It's going to fall. We have had a stock market that has been driven by super, super low interest rates. So if interest rates rise, it's going to hurt the performance of the market, the PEs and all that stuff. So yes, it will. And when that happens and the market starts coming down, and then it starts coming down a lot, I believe that the Fed is going to step in and announce that they're going to start buying stocks. Yes, the Fed for the first time ever will buy stocks. That's my prediction. And Jutamas, let's look at it and see if it happens. All right. Next question from Supercorn says, what type of bonds that you prefer? Okay. I like this question because I want to think about bonds for a moment. Bonds are low return, but they protect your assets, right? If the stock market starts to collapse, if you had your money in bonds, they're not going to go down. That money's not going to go down that much. And then you could use it to buy more equity when the stock market crashes. So then really the function of bonds is not to make a lot of gains. The function of bonds is to protect your downside. And that's the reason why I prefer government bonds. I don't spend a lot of time buying corporate bonds because I'm not buying bonds to earn a lot of return. That's what I'm doing with the stock market. Bonds are my protection on the downside. Now my camera has gone off, so let me just switch cameras. Hold on. Hold on one second. One second. I just got to switch my camera. All right. 1 second. Coming up. I hope that works. Oh, let's see. Hold on 1 second. Have to apologize. I got a technical difficulty here. Technical difficulty. 1 second. There it is. I think we can do it. Okay, got it. There I am. Luckily, I set up a second camera because my other camera is nice, but I still don't really know how to work the battery of the camera and the power. So luckily I set up. So there's a good lesson. Always make sure you have two cameras. So to answer the question, Supercorn, I prefer to buy government bonds, not corporate bonds. Okay. Pangacorn, nice to see you. All right, let's see. Tar, is there any chance for stagflation this year? What are the alternative investments we should be looking for? So stagflation is the case where we have high inflation and low economic growth. High inflation, low economic growth. That is not a pretty situation. Basically, you're trapped. And generally what you don't want to buy is bonds, because bonds in a high inflationary environment are not going to do that well. Also, in that case, you may want to buy more gold. That can be a pretty good performer at that time. And also commodities. Equity is always a portion of the portfolio, because ultimately it's going to be managers of equities that are going to be trying to, make their businesses better. So those are my answers there. All right. Be happy always says, should I buy KEUX now or wait? Just follow my strategy as closely as you can. That would be my advice. All right, Dr. T, what do you think about 3-fund portfolio? world, emerging markets, and bonds, 33, 33, 33. I think that's fine. And, there's nothing wrong with that portfolio. The only thing you could say is that world already has emerging markets in it. So you're doubling your weight of emerging markets in this case, right? Because the world has 60% US, and then there's some other developed countries. Maybe that brings us to 70 or 80%, and then about 20% emerging markets. So your overall portfolio has got a heavy weight in emerging markets. So if, Dr. T, I was to do this, I would say world 40 or 50, emerging markets 10, and bonds the remainder. All right, next question. Pang Panot says, how many expected return in this year of all weather strategy, and what is your opinion about asset allocation movement in first quarter? Okay, so basically, it's very difficult question for anybody to answer the question of what is your expected return in this year. The reality is that we've had, I would say this is one of the most difficult years, because going into this year, I think that it's possible that we could see the market crash by 20, 30, 40% this year, but we could also see the market rise by 20, 30, 40% this year. How could that be? Well, first of all, we have potentially rising interest rates, and the Fed, if they don't step in, the markets could start to crash. But if the Fed steps in, as I believe that they will, then the market's going to go up a hell of a lot, because the Fed has never bought stocks before. They've bought bonds, but they've never bought stocks. And if they do, they'll cause the market to go up by 20, 30, 40%. Very difficult. And that's why I'm okay with sitting on my equity allocation relatively high. And as far as asset allocation in first quarter, I'm not going to make any predictions. I'm just going to sit on what I've got right now that I've presented. All right. Note says, I still remember what you said in previous live ago about high inflation theme from now and not transitory. That's an excellent prediction. Yeah, in fact, if you look at, thank you for that, by the way. And that came from, a lot of work that we were doing. But think about it. It was March of last year that we went overweight commodities. So we were already playing the inflation theme. In fact, if I look at inflation now, I think that we probably have a couple more months, but it could be that we're peaking in inflation. And that's something that I think could be happening over the next, let's say, 3, 6, 9 months. Why? Because the market of businesses and capitalism is going to work, where if prices are rising super high for shipping, more shipping companies are going to try to get containers out there and ships out there. And so, yes, there's some bottlenecks, but generally, I think the market's going to start to work it out. In fact, one of the things I find so annoying is when I hear the government say, the supply chain is very fragile. Have you heard of that? Many people say the supply chain is very fragile. But the reality is that when you shut off, as governments did, the supply chain, it's very fragile. The businesses had been running the supply chain for years, and it seemed to work pretty well. Now, next question. Tanat says, shall we invest in dollar currency? Dollar has been strong, and I think that there's a possibility that dollar could still be strong. But from a long-term perspective, I feel that the dollar eventually is going to come down, and it's going to come down because there's so much debt in the U.S. Now, the reason why it doesn't come down is because every other part of the world is struggling too. So the dollar looks a little bit like a safe haven. The second reason why it doesn't come down is because people believe that the Fed and the U.S. government can do anything, basically. They can basically start printing a ton of money. Now, I'm going to take this off and I'm going to go back into the presentation. And let's see if we can do that. I think this will bring us back. Yep. So I want to talk about a special topic, and that's about that I expect the Democrats to lose control of the House. And basically, I'm going to walk you through a couple of things, right? The first one that we want to look at is this chart. And here, what I'm showing is hold on, I'm losing myself, consumer prices, house prices, and stock prices. And we can get a picture of what's been rising the most. Of course, it's stock prices followed by home prices. Now, let's get rid of the consumer prices by just indexing and looking at the relationship between home prices and CPI and stock prices relative to this consumer price index. And what we can see is that, in fact, in October of 2006, housing prices were 54% above CPI. In September of 2021, housing prices are 67% higher than CPI. And in August of 2021, the stock market was 223% above CPI. And I believe that it's even higher now. So what am I saying? I'm saying that the gap between CPI and the housing prices in the US is actually higher now than it was, it's higher now, this period right here, than it was pre-2008 crisis. There is a housing boom going on in America, and there's certainly a risk that that could crash. So let's go back to Fed tightening, right? The Fed tapering. Why is it that the Fed has a high risk that they won't be able to taper for long? Because why are the housing prices booming? Because interest rates are super low. Anybody can borrow money at at a super low rate. And the result of that is that basically they're feeding a bubble. I call it like feeding a heroin addict. They're just giving it more heroin. And so there's a lot of risk there. And of course, you can see the risk in the stock market. Now, let's talk about the US election. One of the things that's going to be a critical thing all year this year is what we call the November midterm elections of 2022. Now, right now, the Democrat Party has a very, very slim majority in the House. In other words, Biden's Democrat and his party controls the House. That's the best case. And basically, the House is the most important part of the US government because they represent everybody in the US. They represent the taxpayer. So they have almost all the control. So now we'll look a little bit at some states. I classify states into three types: solidly Democrat, solidly Republican. They've always voted either Democrat or Republican, or they lean Democrat or they lean Republican, meaning they've generally voted in that way, but not always. And then finally, what I would say is mixed. They could swing from Democrat to Republican. It's really this swing group that matters the most when we try to understand what's going to happen in the election. Now, here I used this software. And if you ever want software for mapping the US, I highly recommend this software. You can just find it at mapchart.net. And you can do some things like I've done here. I've said that the red is House seat history leans Republican, and the green is House seat history is mixed. And then you can see the blue is Democrat. And what I'm trying to do is understand, and I can see that 8 of the 10 cities are in states that are not solidly Democrat or Republican. They're mixed. So now I looked at a recent survey, and this recent survey came out in November. They looked at 1,000. They went to 1,000 people, and they said, when considering who you'll vote for in 2022, what issue is most important for you? Now, remember, when people are voting in 2022, they're not voting for Biden. They're voting for their representative in the House of Representatives. And basically what I've done is I've highlighted in red the issues that are associated with Republicans and blue with Democrats. Why am I doing that? I'm saying that if the answers that people are giving are mainly red, meaning problems that Republicans can solve, then I think you can say that people will be more likely to vote in Republican. And if what people are saying is important to them right now is blue, meaning Democrat, then they're more likely to vote Democrat. So let's look at that. Here, the first top number one thing, restoring the economy and lowering inflation, that is a Republican issue. Democrats are not good at that. Respecting individual rights and liberties, the Republicans are the ones that stand up for individual rights and liberties, whereas Democrats tend to be more oriented to using the states against people and against their rights and liberties. Addressing climate change, that's clearly a Democrat policy, but that's a third item, number 3 on the list, with number 1 being the most significant in this. And then COVID is another one, but I would say that's kind of neutral. Fighting crime and violence is probably a little bit Republican, but I kept it neutral. And then respecting parental rights in education is a new one that just came on the scene. That is Republican. And responding to aggressions from China, that is Republican. What this tells us that basically 4 out of 7, and you could even say, if we say that this fighting crime and violence is a Republican issue, we could actually add one, and we can say that most of the issues that people are concerned about are solved by Republicans. So now let's look at the major cities. What I wanted to look at was the cities where the states lean Democrat, lean Republican, or were mixed. And now what you can see is that cities that lean Democrat are facing high unemployment and mayors are under pressure. Let's just look at this. New York and Chicago are feeling the heat. You can see that New York has an unemployment rate of 6.3. That's very high. And Chicago at 5.1. That's very high relative to other states. And you can also see that the crime rate of Chicago is awful. It's off the charts. The only one worse than Chicago is Detroit. It's ranked number 2, meaning 1 is the worst. And Milwaukee, Wisconsin, which is also very poorly, right? So, by the way, I just want to say hi to everybody out there that's listening. I appreciate that you take this time on a Tuesday night to spend an hour with me to try to go through the strategy, but also to answer and ask any questions, whether you're on Facebook or you're on YouTube or any other place. I just want to say thank you for coming on and make sure that you ask questions. And so what I'm just trying to do is understand, in this case, what I'm trying to do is look at what states are mixed. So here, what I'm going to do is I'm going to look at the mixed states. All of these states are not solidly Democrats or Republican. Florida, Pennsylvania, Michigan. And I'm looking at what I see about inflation in particular. And inflation is high in some of these states. And I'm trying to predict. Now, there's more to it, but right now, I'm just going to go through it kind of quickly. Now, let's talk about the midterm elections. Midterm elections are every president's first test. U.S. presidents are elected every 4 years, while the House of Representative members are elected every 2 years. This means that every president will face a midterm election 2 years into the term. And if you're watching this right now, basically, you're going to understand the key component of what's going to happen in the election coming out. In theory, if a president is doing well, they should increase their party's seats in the House, which will allow them more aggressively implement their policies. So let's do a review and let's look at presidents from the past. First president was Jimmy Carter, and Jimmy Carter was a Democrat, and his party controlled 17% of the seats. They had a 17% majority. They controlled more than 50%. In other words, they controlled 67% of the seats in the House. But basically, he lost that in the re-election, in the midterm elections. Basically, the House was reduced. The seats of House were reduced. Let's look at Reagan. Reagan was a Republican, and the House was controlled by Democrats, his opponents, and they picked up seats in the midterm election. So basically, Reagan and Carter both lost seats in the House. Bush was a Republican. The Democrats controlled 10% of the they had an advantage of 10%, and that advantage went to 11%. So he lost seats in the House. Clinton, it went from, he's a Democrat, and the House of Representatives went from 9% majority down to 3% Republican. In other words, it completely flipped from Democrats to Republicans, and Republicans took control of the House. That's bad news in that case. Now, George W. Bush is an exception, where he is a Republican, and the House was at 1% advantage of the House when he came in. And then when he had his midterm, it expanded from 1% to 3%. So he's the only one that gained. Why did he gain? Because he had the Iraq War. And the Iraq War basically made everybody feel patriotic, and then they got behind him. Patriotism can win elections. Obama, the great, the Democrat, basically, his party controlled the House of Representatives, and then it flipped to Republicans in his midterms. He lost a lot of control of the House. Trump, 5% Republican advantage went to a 4% Democrat advantage. He flipped the House. Again, another president lost seats in the House. And now the question is, if we add up all of these losses and we add them all up and we average them, we can find that it's about 8% loss is the average loss of presidents that come up for midterm when midterm elections come up. Now, so what do we got with Biden? Biden's a Democrat, and the Democrats control basically the House by just 1% of the seats in the House. And the result of that is that they barely control the House. So what's going to happen based upon all the research that I've done? Basically, the House of Representatives is going to flip Republican between 5 and I would say 8% controlled by Republicans. And that basically means that the Biden presidency is really under threat right now. And this is why they need to keep Powell in place. Now let's look at Biden's disapproval rating. Basically, Biden's approval rating has gone down and down and down, and Biden's disapproval rating has gone up and up and up. And come on, we have to accept the fact that he is declining in his mental capacity, and therefore I expect it to only get worse, and that's going to hurt going into the election. Also, only Trump had a lower approval rating. This is an interesting study looking at ratings 300 days into the president's term, and Trump was at 37, but he wasn't very highly approved, so he fell a bit. But Biden was more highly approved, and he fell down to 42. So Biden is not in a great potential situation for this. And this leads us to Fed Chair Powell. He needs to hold things together for the Democrats in 2022, and it won't be easy. Why? Because first he's got to deal with asset prices. He's got to keep housing prices from collapsing. That means he can't let the interest rates go up too much, or the housing boom and bubble is going to burst. Also, he's got to keep the stock market rally going. If the housing market or the stock market crashes, what's going to happen to the election, the midterm election for the Democrats? They're going to get destroyed, and Republicans may get 10% of the seats in the House. So that's the reason, in my opinion, why the Democrats kept Powell, even though he was appointed by Trump, because he intervened and stopped the market from falling too much by buying bonds, and they probably think he could do it with stocks. Consumer prices. His job is to not let prices get out of control, and they are rising quite a bit. And then there's the economy. He's got to keep the recovery and employment on track. And the government, he's got to keep spending. He's got to provide the financing for government spending. If the government wants to spend money right now, they're not going to be able to borrow money from China. They're not going to be able to borrow money from Japan. They may not be able to borrow money from a lot of Americans that don't want to put in money at 1% or less. And ultimately, the Fed has to be the buyer of last resort. So what's the key point? First, economic and safety pressures on big cities could shift some voters Republican. The odds are against any president gaining House seats in the midterms. Biden is going to lose. Only Trump had a lower approval rating than Biden. And it's up to Jerome Powell to hold things together for the Democrats going into the November 2022 midterm elections. The bottom line, expect Democrats to lose control of the House, and that's going to weaken the Biden presidency. All right, I'm going to go to some questions now and take a short question break. So let's do that right now. Hold on. Oops, didn't mean to do that. I meant to do that. Okay, so let's go and look at some of the questions that we've got. So Warsit says, it's an interesting theory that the Fed may buy stocks. I think the Bank of Japan has done a similar thing. They've done it with ETFs. Yes. In fact, Warsit, let me explain how the Fed did it. They did a really interesting trick. Basically, the Fed is not allowed to buy bonds, and they're not allowed to buy stocks. And so how was it that the Fed bought bonds in 2020 when everything was crashing? Here's how they did it. They went to the Treasury, meaning in Thailand, we would call it the Ministry of Finance. Think of the Bank of Thailand and the Ministry of Finance. Bank of Thailand is like the Fed. Ministry of Finance is like the Treasury Department. They went to the Treasury. The Treasury took $50 million and they started a special purpose vehicle. They started a company and they put $50 million in that company. So the Fed could say, we didn't set up any company. We didn't put any equity in any company because we're not allowed to. No problem. Then the next thing happened is that the Fed lent money to that special purpose vehicle. And when they did, that special purpose vehicle went to BlackRock and said, buy bond index funds. And that's what they did. Now, later, what the Fed said is that they would buy not only bond funds, but they would also buy individual bonds. If companies needed to issue bonds, the Fed would potentially buy them. by the Fed coming in and doing that, they actually didn't spend that much money. Just the signal that they're going to buy caused the bond market. What happened was interest rates in the bond market started collapsing because prices in the bond market started rising. And so the result is that, basically what happened was the Fed stepped in, but they did it in a way where they got around the law. And so that's how I think they're going to do it with stocks the same way. And that's why they kept Powell, because he structured that and made it work. All right. Saranon says, what do you think about India market as a medium term? I still think India is good. I mean, remember that I'm always looking at markets, and I may come out of India. I may go into India. In Alpha Focus right now, we're in India. But as of right now, I like the momentum in India, but I also think that it has some protection against the U.S. market because of the fact that it's not as highly correlated to the U.S. market. Next question, best. Mr. Andrew, do you think just DCA and chill in technology and China fund is still a good idea for long term, or should we start changing the plan? Well, I think that DCA is ultimately the best way to invest because you're just putting in a little bit over time. You're not counting on market timing. I would say that unless you have like a really high skill at it, I wouldn't get as specific as tech and China. I would look at like we saw before for, I think it was Poor Met or someone that said about the 33, 33, 33. That was world, that was emerging markets, and that was bonds. I think that if you want to do DCA and think about the long term, you want to keep it diversified and say by US market or by the global market and that type of thing. So I would keep it much more broad than just tech and China. And then you can chill. All right. Paul says, I noticed that in your allocation, you have both emerging market 5%, Asia ex Japan 5%. Aren't they really similar to each other, especially a high proportion? Would you please explain why you have both? Yeah, there is overlap. And of course, that's a problem that you're always going to face. There's overlap. And I think that it's very difficult for us to avoid it. So one way of avoiding that is to just buy one or the other. But then we also miss something. So the problem that we face is that we aren't going to go down in AWS. We're not going to go down to China so much, or, break the emerging markets down into 10 different countries, or break Asia ex Japan down to 8 different countries. We're not going to bring it down that way. So we kind of have to have allocations to these two funds that do have some overlap. All right. Next question from Tanita. What's the best country asset allocation sector for to invest in for 2022? Well, I think that, as I said, the U.S. market could be the best or it could be the worst. And I just don't know right now. But I would say that we're still overweight the U.S., but I can't say that it's a great long-term play. As I've said, I think emerging markets is a good long-term play. So for 2022, I'm not sure, but definitely you should be prepared. And I would recommend to everybody that you think about being prepared for the U.S. equity market to fall and emerging markets to fall. And when they do, I think that emerging markets would be a good way to look at, a good way to invest for the long term. Poor Met says, besides the FVMR rating, do you have any thoughts on the Vietnamese stock market? Recently, it's doing quite well compared to other countries. Actually, everything, this is Poor Met, this is what you can see is I'm a very structured, rigid guy. I'm the type of guy that gets frustrated when things are out of place, when things are out of order. So in fact, I look at FVMR as my structure that I follow. And that's the reason why you don't often hear me talk about this theme, that type of thing. And that's just something that is kind of the way I think. So I won't say much about Vietnam except to say, yeah, it's an interesting story right now. It's interesting. By the way, if there's anybody on the call that wants to learn about valuation super deeply, consider joining our Valuation Masterclass Bootcamp. It's a 6-week program that starts at the beginning of March, the next one, but it's tough as hell. But I know some of the advisors at Phenomena have been in it, and they know that, you're going to learn a lot. So Alex will put in a link there that can show you a little discount. If you're interested, feel free to check it out. I'd love to have you as my student, and you're going to learn a ton in that. Let's continue on. Poor Met says, which part of the FVMR score that's preventing Vietnam to be added? I don't have the answer to that question right off the top of my head. So I think it could be valuation, but I'm not sure. So I can't answer that right now. When's your next adjustment for AWS port? Can I buy your portfolio now or wait until your next adjustment? I used to buy top 5 portfolios of Phenomena. In only 2 weeks, they'd change some funds. Okay, so with AWS, we're trying not to change it too much. And as you see, we didn't change it in December. The next change is going to come in March. I would say that you're close enough to our past rebalancing that you probably are okay to buy the strategy now and just wait until March and see if we have any change at that time. All right. Jutama says, so if EUX in the portfolio is reduced, should we buy more to maintain the allocation? Percent is reduced. Should we buy more to maintain? I'm not sure if I understand that question. Can you rephrase that a little bit? Now, on that change, my port was negative. Okay, not sure. Let's continue on. Supergorn says, if war happens, what would be the right assets during war? Well, that's difficult. And the first question is, where do we think that war could happen? Well, number one, a potential war with Russia. The number two, a potential war with China. My conclusion at this point is that Russia is in a pretty good position right now. Putin is in a strong position. If the U.S. is trying to fight with Russia, I think that Russia can keep the U.S. from fighting. First of all, because I don't think that Russia is going to invade Ukraine. There's no point. They don't need to do it. So I don't think that they're going to invade Ukraine based upon that. The second thing is that Europe, in particular Germany, has been crazy about trying to reduce fossil fuels. They tried to go green. Everybody wants to go green, right? So they cut out all their coal and a lot of their oils exploration. And what's the result? They don't have enough oil and gas and coal. And as a result, they have to rely on Russia. Russia is supplying a large amount of gas to Germany, and that's and to Europe. And that's why you're seeing energy prices in Europe are up by about 400+%. There is an energy crisis going on in Europe right now. And so if the US tries to fight with Russia, the problem that we're going to face is that Germany and Europe is going to put pressure on the US to say, whoa, if you fight with Russia, Russia is going to cut off our gas, and then we got nothing. So there's a lot of leverage points there. After looking at it, I would say that I'm not too concerned about war with Russia. What I am more concerned about is China, but I would say that China plays the long game. So people look at Taiwan and all that. But the fact is that I don't believe that Chinese people are going to attack Chinese people or the Taiwanese people, let's say, but that I just don't think that they're going to move that aggressively. They can wait it out for Taiwan. So I don't think that they're going to start something there. But if a war happened, I think commodities are a big, big gainer at that time. And the dollar could be really strong. Interest rates tend to shoot up. Inflation goes up really high during wartime. So bonds are not a great place to be. So commodities, number one. And the second would be potentially businesses through the stock market and probably also land. All right. Mel, what's your opinion on inflation? Will it go higher? Should I add finance or defensive stocks or take advantage of increasing interest rate and inflation? I think that inflation is going to probably remain high for the next 3 to 6 months, but we probably are passing the peak at some point, and then it's going to start to come down. I think that interest rates, the government, the Fed's saying that they're going to increase interest rates, but I would say that, in fact, I don't think that that's going to happen anytime soon. So now I'm just going to think about, I don't know if we've got any more thing. I just want to look at our presentation. 1 second. There's a lot more stuff that I want to cover, but I don't want to go beyond our time. And I know it's 8 o'clock right now. So I think at this point, I'm going to leave it here and I'll take any final questions. Let's just go through any final questions. Omicron, that's great, says thanks. Yes, Micron says thanks. Alex has put up the information about the Valuation Masterclass Bootcamp. If anybody wants to become a valuation expert and learn about the V and FVMR, we've got a super discount right there. You can click that link. All right. And Bunyamon says, what do you think about China's tech stock? Will you consider to take it to the portfolio in the near future? The answer to that is probably not. And the reason why is because, remember, AWS is not getting that down. We're focusing on stocks, bonds, commodities, and gold. So we're not going to go down to that level. In Alpha Focus, we could, and that could come in, right? All right. Paul says, thank you very much for your insightful session. I learned new today. Stay safe. By the way, for everybody on, I also have 2 different things that I've got going on. So feel free to reach out. Number 1 is a book club. We're doing the best business book clubs of all time, where we're going to read 1 book for business each month and then learn about it and share about it. And the second thing that I've got is a mastermind group. There's a small number of business people where I get together and we try to meet once a week and try to help each other to run our businesses. So I think at this point, I'm going to end it there, and I'm going to leave it, and I'm going to say goodbye to everybody. I think I got to go see if my mom's gotten back. She's out having Italian food at Limoncello. For those of you who have been there on Sukhumvit 11, fantastic place. She probably had a nice glass of wine and some ice cream and other stuff. Let's see. But I appreciate everybody on here, and keep your questions coming. If you have more questions, feel free to send them to Phenomena staff, and then we can try to look at them and address them. I really appreciate everybody for the support that you've given. And it's my goal to try to protect the downside of the strategy of the portfolio and try to get as much upside, but also to do that without getting too caught up in my emotion and stay strong, right? Stay strong to my emotion. So thank you all for that. It's 8:06. I appreciate the time together. Keep the questions coming to Phenomena team, and I'll do my best to try to answer them. Poor Met, nice to see you, and I look forward to seeing you in the book club. Just ask your staff or send me an email or Alex an email if you've got any questions on that. I can always be reached. Here's my email. If anybody wants to ask a question or go over a specific thing, I'm going to just put my email in there, and you can send me an email you want to ask about a particular issue that you have, if you want to ask about a particular situation, if you want to ask about the book club, the valuation masterclass, or anything else, feel free to ask any question, and have a great evening. Again, thank you, everybody.
ในโลกของการลงทุนทุกคนเปรียบเสมือนนักเดินทางคุณคือนักเดินทางแบบไหนมีเงินแต่ไม่มีเวลาเลยไม่รู้ว่าจะเริ่มยังไงใครว่าดีเราไปหมดแต่ก็ไม่ค่อยเวิร์กยังมองหาโอกาสใหม่ๆถึงจะไปมาเกือบหมดลุยเดี่ยวแต่ต้องเจอความเสี่ยงแบบไม่คาดฝัน
กินดอยแล้ว
เพราะโลกของการลงทุนเต็มไปด้วยหลากหลายความต้องการ FINNOMENA Exclusive บริการที่ปรึกษาการลงทุนส่วนตัวพร้อมพาคุณเดินทางไปอย่างไม่โดดเดี่ยวแนะนำเส้นทางที่ใช่ให้คุณเลือกไม่หลงเป็นเมาเพราะเราช่วยชี้ทางออกเดินทางได้สมูทยิ่งกว่าเซลล์ในเส้นทางการลงทุนเดินทางสู่ความสำเร็จตามเป้าหมายของคุณเริ่มต้นลงทุนที่ 500,000 บาท FINNOMENA Exclusive ที่ปรึกษาการลงทุนส่วนตัว